Holy smokes, Tom Lee just went on CNBC this morning and dropped some big news for investors. Tom Lee believes a multi-year bottom is forming for small caps, that the real risk to reward is in small caps. And Tom Lee also thinks 4 cuts by the end of this year, 4 to 5 cuts by the end of this year is in play from the Fed. Take a listen to this clip from CNBC and Tom Lee and let me know your thoughts down below in the comments section, and stay tuned because we have a lot to talk about.
Down the road ahead for stocks as we head into the sometimes tumultuous month of September, as Fundstrat Global Advisors co-founder, head of research Tom Lee joins us here at Post 9 on a summer Friday. Tom, thanks for coming in.
Great to see you.
Was it last week? Was it difficult to keep your bearings in the midst of that crazy price action?
Without question, because the market had been whipsawed by data point to data point, as you guys were recapping. You know, the jobs report raised recession fears, big risk off. Then we got inflation this week, which was pretty tame, and I think markets suddenly went back to thinking about liquidity coming into markets. I think that the data dependence of the markets and the Fed is very tough for investors. And I think if you look ahead, I'd say we always know the summer is tough. Summer probably runs through October, but I don't think that anything's changed into year end, which should look pretty good.
But are you lower conviction now than you were 2 weeks ago?
No change in our conviction, but it is just recognizing August historically is a tough month for markets. I mean, one thing that maybe investors can be encouraged by is since 1928, the most common month for the summer low is August, and the most common week is the first week of August. So I think maybe the worst is behind us, but it doesn't mean we're straight up from here.
Right, and I guess the question is, I keep going back to, that moment in mid-July when we were at the highs. You were just shy of 5,700 on the S&P 500, and everything was a go. It was, the AI earnings path was kind of unquestioned. In addition to, general soft landing expectations, you kind of didn't have a lot of painful trade-offs to worry about in terms of policy or growth. Can we get back to something like that? I guess the idea, as you say, maybe summer lasts through October. Do you expect that we're going to have to continue to reset around these levels?
Yeah, I think if my best guess would be, it's still going to be a struggle, but we're climbing the escalator again. I think Jackson Hole is going to set a positive tone on balance, just because the evidence is growing. FOMC members want to be forward-looking, as you guys are pointing out. Data dependence is dangerous at turning points. And then we get the jobs report for August, which I think should reverse some of things that could be temporary. I mean, that's a guess, and if it is, then recession risk is sort of reduced. But now we have real rates are too high, and that means investors will be comfortable with cutting.
I'm thinking back to some of the notes you wrote after the last jobs number, and you looked at Hurricane Beryl and the number of companies in Texas that had no power for 2 weeks, and you do think August will be reassuring on the NFP print?
Yes. I mean, in some ways, the weekly claims is telling the story. We had a surge in claims, multi-month high that have come down since then. And so even if someone says there was no effect from the hurricane, how do you explain claims really improving so much, especially in places like Texas? And, a million homes without power for 2 weeks, how could that not affect the local economy and the jobs market?
This rebound that we've gotten from the lows of early last week, initially, certainly until yesterday, it was back to the first half winners. It was a lot of the mega cap growth stocks, and the equal weight S&P really didn't have that much of a pullback, and it's closer to its highs. But small caps definitely got a flush, and yesterday they rallied big on that retail sales number. But it seems like that's still been a complicated attempt at a rotation.
That's right. They always say bottoms are tough and bottoms are a process, and small caps are really in the process of what we think is a multi-year bottom. And so conviction is not going to be as strong as things that have been working. I think most people's toolkit is to buy the triple Q, the NASDAQ or the AI names when they want to get back in the markets. But cutting rates at a time when small caps trade at 10 times forward PE, better earnings growth, and then a visible path to easing, I would say it still makes sense that the risk reward is in small caps.
And then, we had a miss on housing starts this morning. So it's funny, is the parts of the economy you thought you could rely on for a while, maybe are giving way as other ones maybe start to bottom. But what's your thought there in terms of the flow through to the rest of the economy?
I think housing, auto sales, and durable goods are essentially in recession. Mm-hmm. It makes sense because cost of money is so high. I mean, it's super expensive and hard to afford a home or to buy a car with these rates. These are also directly benefiting from Fed cuts because adjustable rate mortgages adjust, business loans adjust, auto loans, credit card, they're sensitive to short-term
builders'
rates.
loans too. I mean, if you're building
that's
a house.
right. Cost of money for builders, yeah. And so I think these really benefit from an easing cycle, but a market that believes there's an easing cycle underway.
How many cuts you think we get this year?
I'm looking at consensus, which is somewhere between 4 and 5.
Before the end of the year?
Yes.
So about 100 basis points?
I think that's right, but it depends on where inflation prints the next couple months. But our base case is that we're on a glide path towards 2%. That's better than consensus. So I think 4 to 5 still makes sense.
And you've been, part of your thesis has been that elements of CPI have been falling, in your words, like a rock.
Yes.
I actually saw that phrase repeated in another desk note yesterday, so that's spreading. But are you as assured of that? And when you look at things like car insurance or some of the coincident costs of owning a vehicle, as you point out?
Yeah, I think one of the things that surprises us still is that two things are keeping inflation high on a weighted basis: shelter and auto insurance. Auto insurance adequacy is there now. If you look at the results from these auto insurers, they don't need to raise rates, so I think that's cooling, and that'll come in the second half. And for housing, rent is stabilizing, and I think housing is going to cool. It just needs to get to 3 to 4%, and then markets will be comfortable that we're back at 2. But median inflation rate is still 1%. That's below Fed's.
Yeah. Well, I think as Greg Ipps said this week, rents are inertial. It takes time for those new rents to cycle in.
Yeah, that's right.
So I think that was pretty fascinating from Tom Lee. As I mentioned in the beginning of this video, Tom Lee expecting 4 to 5 cuts this year. That's pretty far past consensus. In a way, markets are only pricing in about 3 cuts the end of this year: a cut September, a cut November, a cut December. We're no longer pricing in that 50 basis point rate cut coming September 18th. In fact, the odds of a 50 basis point cut September 18th sit at 23.0%. The odds of a 25 basis point cut are 77%. And even from yesterday, the odds of a 50 basis point cut dropped from 29% to 23% today. So the odds of a 50 basis point cut have been rapidly falling. This would actually be good news, as I've said many times here on this channel. The markets kind of extrapolate Fed policy into what does that mean for the economy? Meaning if we get a 25 basis point cut versus a 50 basis point cut, that's actually good news. If we get a 50 basis point cut, if the Fed decides to cut rates faster, then the markets say, oh wait, what does the Fed see in the economy that's causing them to cut rates faster than what they otherwise would have? And really, bottom line, the economy is more important than the Fed, inflation, China, geopolitical tensions. It's more important than everything else in terms of how markets perform. Normally, it's actually a sell the event when the Fed cuts rates for the first time. But if the Fed only cuts rates 25 basis points, again, versus the alternative, which is 50 basis points, the markets may actually like that. Now, I also found what Tom Lee said pretty interesting, where he thinks the bottom is in for the S&P, that normally you bottom in August, the first week in August, which looks to have played out perfectly, but he doesn't think it's going to be straight up, which suggests that maybe we're in for some short-term consolidation or a little bit of downside volatility from here. I mean, after all, you fell precisely 10% from the high to the low, and you've already rallied almost 8.5% from that low. Just in the last couple of days, you've seen a massive rally. In fact, according to Gunjan Banjiri on X, the S&P 500 has soared 6.6% over the past 6 trading sessions. It's the best run since November of 2022. And let's be honest here, as the economy is slowing, as we're heading into the first Fed rate cut, which historically leads to over 20% downside for the S&P over a course of about 90 days or so, what's the risk reward in the S&P? It just doesn't look attractive here, as you're still sitting at very high levels, as we are pricing in basically perfection for 2025 expected EPS. Like, throughout that whole 10% correction, you did not see estimates fall for 2025 EPS growth. So I think Tom Lee makes a great point. If we ultimately avoid a recession, if the markets look at the Fed cutting 25 basis points September as a positive, I do think small caps, the interest rate sensitive areas, which he says are in a recession, will really be the ones to benefit and have the most to gain. I really don't think the headline S&P would gain at all. Because let's be honest, part of the reason the headline S&P and the NASDAQ have done so well versus your equal weight S&P is because of this perceived recession safety in your mega cap tech, which we all know is not true. If we go into a recession, mega cap tech is going to get destroyed as well. But that's the perception on Wall Street. And when that area of our markets, your top 6 stocks control almost 40% of the weighting in the SPY, it really doesn't matter what the rest of the markets do. If, let's say, for simple math sakes, those 6 stocks double in a year, and they're 40% of the index, that's 80% of the index return. You could have the rest of the markets do nothing, and you're still gonna soar for the S&P 500. Now, let me present you this. As the Fed starts to cut rates, if the markets perceive that as positive, as we're heading towards a softish landing, then what's gonna happen to big tech? You're actually gonna see big tech see outflows. And I would imagine a lot of consumer cyclicals, a lot of quality dividend stocks, a lot of value, a lot of interest rate sensitive growth, small caps would actually be the ones that start to lead markets. And their weighting is so low in the S&P, if any weighting in the S&P, you could actually see those parts of the markets rally and have basically no effect on the headline S&P. We kind of seen that a couple of weeks ago when the Russell was soaring and the S&P was doing like nothing. In fact, some days the Russell would be up like 3% and the S&P would be down on the day. That's potentially what could happen again, perhaps to a less extreme degree. Because remember, there's still going to be recession fears for probably the next year. To be honest, I think we're going to have recession fears out there at least until the Fed cuts to neutral, which is like, 250 basis points from here. And at the pace in which the Fed is forecasting, that's going to be at least a year. So I don't think the recession talk or fears, if you will, are over anytime soon. It's going to be something that is just on the back of our minds for a while. But I do think Tom Lee is generally correct. If you are bullish on markets, I don't think you should be bullish on the headline S&P. Again, because the 40% weighting in the S&P will actually lose when the Fed starts to lower rates. Again, from so many different standpoints, the perceived safety trade during a recession, well, mega cap tech's not going to benefit from that. The cost of capital going down, mega cap tech is not going to benefit from that. In fact, mega cap tech will dollar for dollar lose money as the Fed starts to cut rates, because Google, Apple, Microsoft, all these companies with 100 billion plus in cash sitting in the bank, they're just collecting free interest on their money. And the whole time the Fed has been raising rates, it really hasn't affected their business. Okay? So they're just going to take in less interest income. That's not great for big tech. So in a weird way, I actually think you could get a sell the first Fed rate cut reaction in the S&P because of big tech potentially selling off, but the rest of the markets could actually do very well. Now, Fed Goolsbee came out and said quite a few different statements today that really caught my attention. He says, first up here, when labor markets start to turn, it tends to worsen fast. He also says you don't want to tighten any longer than you have to. This is not what an overheating economy looks like to me. And this is probably the headliner that caught the most attention. Fed's Goolsbee says some leading indicators of recession are flashing warnings. He also says we want the job market to stabilize. There are concerns it'll weaken more. And last but not least, he says GDP is still pretty strong and there are pockets of strength in the economy. Then you get headlines like this. According to Unusual Whales, 3 out of 5 Americans think the US is in a recession. per a firm. 55% believe the economy is shrinking, and 56% think the U.S. is experiencing a recession, even though the broadest measure of the economy, gross domestic product, GDP, has been growing. And this is one of those, again, data points that is pretty reflective of what I see out there. If you ask people if we're in a recession, a lot of them don't, most of them don't know what actually defines the economy in a recession or not. Most people are not going to know it's 2 declining quarters of GDP growth, but this just shows people feel bad about the economy. They're not spending as much money. They're not saving as much money. They're not bringing in as much money. Perhaps some have lost their jobs or can't find a better paying job. It's hard for me to fathom that if 3 out of 5 people feel like we're already in a recession, that at least we don't see further weakening. Okay, even if we don't go into an actual recession, it's hard to believe that things just get better from here. It just doesn't seem likely to me. Sven Hendrick is reporting that it looks like retail investors piled in this latest fall as asset managers actually dropped their exposure to markets. And this is pretty normal, especially on the first sign of volatility, because you tend to see fund managers that adjust their portfolios around volatility. Okay, as volatility picks up, risk picks up, and you see fund managers deleverage that risk. And that's actually, represented here, the NAAIM exposure index. As markets have been going higher, big money has been selling this rip. And now you're at the lowest exposure you have seen since what looks like the start of 2024. From fund managers. We are also getting some data out today. They talked about this a little bit in that Tom Lee interview, but there is now 476,000 new homes for sale in the US, the highest inventory since February of 2008. This is according to the OPI desk. Goldman Sachs says July housing starts fell sharply in the South. We left our Q3 GDP tracking estimate unchanged at 2.4%. Liz Young Thomas says bad weather might be skewing the data, but housing data was weak. Housing starts came in at 1.238 million, the lowest levels since early 2020. Units under construction falling as a result, which is a concerning sign for construction employment. And what's notable about today and really the past 2 days is the Atlanta Fed GDP Now tracker. So 2 days ago, the Atlanta Fed GDP Now tracker was at 2.9%. Okay, almost 3%. Yesterday, it was brought down to 2.4%. This was export prices, import prices, industrial production, year over year, month over month figures. This was business inventories that brought that down 0.5%. Now, today, according to housing starts and according to some of the smaller data points we got today on construction, the GDP estimate fell from 2.4% yesterday down to 2% today. Now, that's quite a drop for a 2-day period of relatively mild data, okay? Going from almost 3% to 2%. Wall Street's blue chip consensus for GDP is around 1.8%. That did fall from about 1.9% as well. So starting to see GDP going lower. Now, this is for Q3. There is a long period of data in Q3 that is going to affect these GDP estimates. And at this rate, if we get data that just continues to come out kind of the same trend that's lower, you could see GDP much lower than even where we are now. And I think this could coincide with how stocks perform. But remember this quote from John Templeton. This says, stocks are built on pessimism. They grow on skepticism. They mature on optimism, and they die on euphoria. Where do you think we are right now? Are we in skepticism? Pessimism? I don't think we're at pessimism yet. Skepticism, perhaps. It actually sounds like stocks could do well from here. At least small caps, in my opinion. We're pretty firmly in the pessimism camp. for small caps. We did have the University of Michigan data that came out today. Specifically, current conditions came in the worst you have seen since December of 2022. And this is another one of those data points that says, people do not feel good about the current conditions of the economy. How does that not translate into a weakening economy? Okay. All you need right now for stocks to go lower is a weakening economy, not necessarily recession, just the economy on a downward trajectory. Retail sales really enforced that maybe that's not happening. But when you're getting data like this, that's just basically going straight down, that doesn't tend to lead to stocks doing well. I mean, look at 2022. This is when recession fears were hitting their highest, when the University of Michigan current economic conditions plummeted, right? Back here, this was the low of 2022, right? As markets were down almost 30%, but it was just falling consistently. That's what's happening again. That it tends to correlate to how markets do. Nonetheless, the actual headline number did beat estimates, coming in at 67.8. The estimate was 66.9. Last month's number was 66.4. Part of this was because 5-year inflation expectations came in line with estimates, the same as last month, at 3%. 1-year inflation expectations also did not move, coming in line with estimates at 2.9%. Michigan current conditions, again, came in at 60.9. That is the worst number since 2022. The estimate was 62.3. So pretty decent miss there. Consumer expectations did jump a little bit from 68.8 to 72.1. The estimate was 68.2. So that was a little bit better than expected, but currently, people do not feel great about the economy. As far as the markets, from a investor's perspective, I mean, you're above your 50-day moving average, you're above your 20-day moving average, you're above your 100-day moving average and your 200-day moving average. You've seen a very aggressive bounce back. Don't be surprised if we trade between 555 on the SPY and 543 or so with this 50-day moving average. I think you'll get a lot of support here if we do come down to that 50-day moving average, but don't be surprised if that does happen. Now, the problem with equities right now, really over the next week, is we don't have much for economic data. We have a couple Fed speakers, we have some bond auctions. That's really it. I guess you can say we do have initial jobless claims on Thursday. We have the FOMC minutes on Wednesday. Thursday, you have continuing jobless claims, Kansas Fed Composite Index, Manufacturing Index, S&P Global Composite PMI, but really don't have anything for next week. You do have some earnings that could be the main story for next week, but it's actually not next week. It's the following week that's going to be very impactful for markets. A lot more economic data, NVIDIA earnings, the Jackson Hole Economic Symposium, where Fed Jerome Powell will be giving a speech. He may declare victory on inflation and signal a strong willingness to start cutting rates. Big question will be 25 basis points or 50 basis points. But really over the next week, there's just not much going on. And stocks tend to follow the path of least resistance. And at least recently, it looks like the path of least resistance has been higher. So it is possible we could go higher, but now you're 2% off of new all-time highs. I don't see a catalyst to get us to new all-time highs. I mean, could it happen? Yes. Is it likely? Probably not. Even as Tom Lee says, we're probably pretty exhausted on this upside rally and essentially expect a lot of volatility. So, ladies and gentlemen, that is going to go ahead and conclude this video. That is all you need to know. I will point out before we go ahead and wrap this up, 10-year Treasury yields today are down about 2 basis points to 3.90%. CNN's fear and greed indicator has bounced back sharply, now only at 35, which is about midway through fear, getting closer to neutral. VIX continues to get slammed today, down another almost 3% to $14.82. And oil is down about 1.25% today. The dollar is up 0.4% today, but it's a pretty slow day out there. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.